Lithium Americas Corp is currently trading at $5.80 as of 12:03 p.m. EST on Monday, January 12, 2026, marking a sharp intraday jump of 7.61% with a price increase of 41 cents since the opening bell. While most retail traders are staring at the screens of their Robinhood app or checking their Fidelity mobile app for a quick swing trade, they are missing the deeper structural shift that just occurred under the surface of the lithium market. The immediate expectation from the broader market was that lithium would remain in a stagnant glut well into this year, but the reality is that we are seeing the first signs of a domestic supply squeeze that the big institutional players at Interactive Brokers and Fidelity Wealth Management have been quietly positioning for over the last few fiscal quarters. The surprise that most people missed this morning isn't just the price action. It is the quiet movement within the federal legislative framework regarding the Energy and Water Appropriations Bill, which appears to be carving out a much more aggressive path for domestic critical mineral development than the market had priced in even a week ago. This shift creates a massive tension between the public belief that lithium producers are a high-risk gamble and the reality of a strategic domestic asset that is being de-risked by the federal government in real time. If you have been looking at your individual brokerage account lately, you have probably seen the headlines about the lithium oversupply that defined the end of the previous year. The common ground among investors is the belief that because lithium carbonate prices hit multi-year lows in North Asia, companies like Lithium Americas Corp were doomed to bleed cash until 2027 or 2028. However, the reality we are analyzing today suggests that the market is beginning to decouple domestic U.S. assets from the global spot price volatility dominated by Chinese supply chains. This is where the curiosity loop begins for anyone involved in self-investing or using investing sites to find an edge. While the average person might be distracted by the volatility of Tesla stock or Apple stock, the smart money is looking at the $2.26 billion Department of Energy loan that Lithium Americas is currently drawing down. This isn't just a loan. It is effectively a strategic partnership with the U.S. government that makes the company's Thacker Pass project in Nevada more of a national security priority than a simple mining venture. When you compare this to the growth trajectories of tech giants like Nvidia stock, the risk profile is obviously different, but the potential for a massive re-rating is actually quite high as the project nears its 2027 mechanical completion. The recent movement we have seen in January has been nothing short of aggressive. Just a few days ago, on January 5th, we saw a 9% rally driven by the first hints of this federal support. Today's action, pushing past the $5.80 mark, is an extension of that momentum. We are seeing institutional activity pick up significantly. If you look at the 13F filings through your Interactive Brokers platform or analyze the fund flows on Fidelity Brokerage, you will notice that names like Van Eck and even General Motors have held firm or increased their exposure. This institutional backbone is what prevents the stock from falling back into the $2 and $3 ranges we saw when sentiment was at its lowest. In fact, institutional owners now hold roughly 27% of the float, a figure that has remained remarkably stable despite the brutal commodity cycle. This tells us that the reality for big banks and strategic partners is a long-term play, while the expectation for the retail trader is often a short-term gamble that leads them to sell at the bottom. Let's break down why this specific Monday is seeing such a surge. Beyond the legislative tailwinds, the company's subsidiary activities in Argentina have provided a much-needed operational update. Seeing actual production results from the Caucherry-Olaroz project gives investors a tangible sense of progress. It proves that the management team can actually move a project from the design phase into the production phase. For those of you using Schwab Intelligent Portfolios or other robo-advisor tools like the SoFi Robo-Advisor, advisor, these types of fundamental wins are often the triggers that rebalance your holdings into more aggressive materials sectors. It is also worth noting that Lithium Americas was recently added to the S&P TSX Composite Index, a move that forced index tracking funds to buy up shares, creating a floor for the price action we are seeing today. This is a classic example of how structural market shifts can override simple commodity price fears. Comment below how many shares of Lithium Americas Corp you currently hold, or if you are waiting for a dip back to the $5 level before you enter. The business model of Lithium Americas is uniquely centered on Thacker Pass, which is slated to be the largest lithium source in the United States. They aren't just digging a hole in the ground, they are building a complex processing plant that is currently over 80% designed, with steel being erected on site as we speak. This is the reality that challenges the skeptical market narrative. When people talk about online investing and look for help with their portfolios, they often forget that mining is a game of patience and permits. Lithium Americas has cleared the major legal and regulatory hurdles that often sink smaller junior miners. They have a massive cash pile, sitting on nearly $400 million in liquid assets as of their last major report, and that doesn't even account for the ongoing draws from the federal loan. This financial cushion is critical because it prevents the type of death spiral financing that many other lithium plays have had to resort to. However, investors using platforms like Robinhood or SoFi Invest should be aware of the dilution risks. The company has been active with its at-the-market equity programs, which effectively means they are selling new shares into the market to fund construction. While this keeps the lights on, it can cap the upside in the short term. Comparing Lithium Americas to other popular picks on investing sites like Interactive Brokers or Fidelity, you see a clear distinction. Unlike a software company or a consumer tech brand like Apple, LAC is tied to the physical reality of construction and commodity pricing. But the expectation that it will follow the lithium spot price forever is starting to look flawed. As the U.S. moves towards a closed-loop domestic battery supply chain, the reality is that the price of lithium carbonate in Nevada might eventually carry a green premium or a domestic premium over the prices in Shanghai. This is a concept that serious investors using Fidelity Wealth Management or Interactive Brokers trading are starting to discuss more frequently. If the U.S. government implements a minimum floor price for domestic lithium to protect its billions in investments, Lithium Americas becomes an entirely different animal. It transforms from a cyclical commodity play into something resembling a protected utility. The future outlook for the remainder of 2026 is dominated by construction milestones. We are looking at a peak workforce of 1,800 people on site by the end of this year. Every foundation poured and every long lead equipment item delivered from Canada or the EU is a de-risking event. For the self-investing crowd using the Robinhood app or SoFi Active Investing, these types of fundamental wins are the reality that will either confirm or deny the current bullishness. If the company hits its goal of 90% engineering completion and keeps the Phase 1 processing plant on track for a 2027 start, the stock could easily test its 52-week highs of $10.52. On the flip side, the risk remains in the macro environment. If electric vehicle adoption continues to lag behind the more aggressive forecasts, the expectation of a supply shortage in 2027 could be pushed further out, causing the stock to drift. The institutional side of the house is where the real conviction lies. When you look at the holdings within the Fidelity mutual funds or the specialized lithium ETFs like LIT or REMX, you see Lithium Americas as a core component. These funds aren't trading the daily noise. They are looking at the 2030 horizon. They recognize that the total addressable market for lithium-ion batteries is projected to triple by 2033. For an investor looking for investment help or exploring online investment options through a Schwab Intelligent Portfolio, these long-term demand curves are the strongest argument for holding through the current volatility. The gap between what the average investor expects, quick profits like those seen in Nvidia stock, and the reality of a decade-long infrastructure build is where the true value is found. To summarize the situation we are seeing today at the $5.80 price point, we are witnessing a significant recovery from the lows of early 2025. The market is starting to realize that Lithium Americas is not just another mining company, it is the cornerstone of the U.S. strategy for energy independence. The expectation was that high-cost Western production could not compete with cheap Chinese supply. The reality is that federal intervention through loans, tax credits, and potential floor pricing is leveling the playing field. This tension between these two perspectives is exactly why the stock is showing such high volume and volatility today. We have moved from a phase of total despair and liquidation to a phase of cautious accumulation. As you monitor your individual brokerage or check your positions on the Robinhood stock trading platform, keep in mind that the current rally is built on a foundation of structural shifts rather than just a temporary spike in commodities.